used in this firm. Equal proportions. If it is 1.5, 1.5. So at the time, the total debt would be 1 rupees and 50 cents, while the equity value is 1 rupee. For 1 rupee of equity, 1 rupee and 50 cents obtained as a debt to run the business. So it is very dangerous situation. Lenders will control everything in that case. Then another second version is given as gearing ratio. Gearing ratio, a long-term debt is used. In the previous one, total debt, meaning long-term debt, preference capital, and short-term debt also, current liabilities. Here, the long-term debt is taken. Denominator would be the total equity plus long-term debt. Out of the total, how much debt? Long-term debt. This also should be indicating that the gearing, capital gearing, to what extent the long-term debt has been obtained out of the total capital needed to business. So if the result is more than 0.4, more than 0.5 at the time, you can do some interpretation. If it is more than the 0.5 capital gearing, you can interpret it as a higher gearing. Higher gearing. The result is less than this the 0.5. You can interpret it as a lower gearing. So 0.5 is a borderline. So you can find the effect of this the long-term debt on the performance of this the administration of these companies. So there are some advantages and disadvantages of having this the gearing, capital gearing. The lower gearing and the higher gearing have the equal advantages and disadvantages. When the firm is going with the higher gearing, some advantages may be coming, but in the most of the case, disadvantages are there. The case of this lower gearing means the long-term debt is lower out of the total capital. At the time also, it would be benefiting that firm, but some opportunities, benefits would have been sacrificed by the firm in getting this long-term debt capital. So usually that the firms going for the long-term debt to make some investment in the profitable ventures, general investments, with the expectation that they can use the opportunities and earn the profit. Because the capital cost, service cost of the long-term debt, it is fixed. So it would be easy for the firm to predict the future profit level should be there in with any investments. So they can, using that the fund, they can do the investments and earn more profit. They can go for the business development, buying the new plants, modernizing. But raising the equity fund would be costing more. And also, when the profit are earned more with applying the equity fund, definitely the equity, the profit should be distributed to the equity holders in terms of the dividend, cash dividends. So they can claim for the cash dividends. At the time, when you compare with the cash dividend with the interest payment dividend, cash dividend would be more than that of the interest payment. So at the time, it cannot be beneficial to this the company in raising this equity fund. So in the literature, some kind of discussions are there to understand the meaning of this gearing. Then it fixed asset, fixed interest coverage. So when the firm is going with the loan capital, long-term capital, they should be able to meet the liability of the paying the interest on time. So the firm should have earned more than the more profit, so that they should be able to pay the interest on time. So the how many times the interest, fixed interest, is protected with that net profit before interest and tax. So it should be divided and with the fixed interest. Then the fixed interest coverage rate would be identified. It should be definitely more than one. More than one. At least 1 rupee of pay the 1 rupee of interest. The firm should have generated 1 rupee of net profit before interest and tax. There is a cutoff. So as long as the company has the fixed interest coverage, so it would be interpreted that the company has good solvency in terms of paying the fixed interest out of the profit. Likewise, fixed dividend coverage is also there. Fixed dividend means that the preference share dividend. That's also the legal obligation for the company to pay. The profit is not available in a particular time period. It can accumulate. It should be paid with the arrears in the future years. So company cannot deviate from the obligations paying this as the fixed dividend. So that's why it should be taken into the evaluation of long-term solvency. Net profit after tax is taken as a numerator and a fixed dividend. This also should be more than one to be interpreted as a good solvency. Right. That's all about the different ratios available to evaluate that the long-term solvency of companies. Then the growth ratios, growth potentials, or market ratios are applied in the ratio to evaluate that and the market potential, growth potential of firms. Earnings per share, dividend per share, dividend payout, price earnings, and the earning yield, dividend yield, everything there. These ratios have been generated, the literature with some specific purpose to evaluate the particular aspects of this the growth. Say earnings per share is used to evaluate the earnings potential, total earnings potential of the company. Dividend per share is calculated to evaluate that the ability of the company to pay the dividend per share basis, and the dividend policy also would be highlighted, disclosed by these other dividend per share analysis. So the different items here have a different purpose. Earnings per share. So you would have studied in the advanced level this earnings per share. This is called the basic formula to calculate the earnings per share. So some advanced models also there. So those are called the diluted earnings per shares. So there's a standard for guiding how to prepare this, how to calculate that the diluted earnings per shares, etc. So because this is an important information, the investor can apply in the making the decisions regarding this their buying and selling activities. So what is the numerator? Profit after tax and the preference dividend. Number of ordinary shares outstanding. So actually it should be taken as a weighted average ordinary shares outstanding, weighted average. Weights being calculated by some calculations changing in the outstanding number of shares in a particular time. So the time fractions become as a weight, calculating the weighted average ordinary shares outstanding. So those are the advanced cases. As a fundamental, you can just consider number of ordinary shares outstanding at the year end, as given in the year end balance sheet. Indicates whether or not the firm's earnings power on per share basis has changed over a period. Can show that the profitability of the firm on a per share basis. It does not reflect how much is paid as dividend or how much is retained in the business. So that's why you want to generate another indicator for the growth. Dividend per share. Here the ordinary dividend for the period declared or paid is taken and is divided by number of ordinary shares outstanding. It indicates the amount of earnings of the firm distributed as cash dividend to the ordinary shareholders on a per share basis. So not that it should be the paid dividend. Sometimes the firm can the policy of declaring and then later they can pay the actual amount. So usually nowadays that the dividend declared cannot be stated in the financial statements. It should be disclosed separately in the note. So liability, payability, liability is not recognized. Paying the dividend, it's a liability is not required. Can indicate dividend policy of the firm also. You want to learn about our dividend policies. So you know that the ordinary shareholders are not guaranteed with the dividend. So they can earn the income from investing in the shares by the way of gaining capital gains. Capital gains by trading in the secondary market. So if they buy the shares for 1,000 rupees for a day, and in 1 or 2 days they can sell it for 1,000 200 rupees. So the 200 rupees become as their income. So they can't expect that the dividend would be their income. But if the dividend are paid, the holder at the time of the dividend paid would be benefited. So when the dividend is paid, the liquidity is affected for the firms. The cash is going out of the firm. It cannot be recovered anymore for investments. So the firms and the companies would be benefited if the total income are reinvested or retained in the business as investments. At the time, the business would be developed and their capital, the share value also would be appreciated. But there are some shareholders who can prefer that as the cash dividend. They don't prefer the capital gain, only cash dividend. Waiting for cash dividend. So that sense, that kind of customers, the shareholders, investors, potential investors. So from that, the dividend per year, any investor can evaluate what is the dividend policy they are having. The continuous rate of changing rate, so increasing rate of, they can judge it. Then the dividend payout ratio is introduced, comparing the dividend per share with the earning per share. How much of the dividend is paid out of the earnings on per share basis? Whether 50% or 100% or the 78%, 28%, 10%, it would be arranged with that. They indicate the proportion of earnings of the firm distributed as cash dividend to the audience shareholders on a per share basis. Can also indicate the dividend policy of the firm. Major earnings are distributed or small earnings, small portions of earnings are distributed. Then the price earning ratio, it is the very much used market ratio by the investors. Market value for an ordinary share should be compared with the earning per share. It indicates investor judgment or expectation about the firm's performance. You get investor judgment and expectation about the firm performance. So the market value is the quoting price of the ordinary year by the participants in the secondary market. When the earning per share is higher, the market value would be higher. So there's a connection between the earning per share and the market value. The market value is more than the very high. The price earning ratio is high, meaning that the market value is high, resulting in the higher price earning ratio. That the good indicator of the expectation for performance. So the higher the ratio will give the judgment in favor of firm performance. So you to understand very clearly, you want to go for this kind of website notes about this price earning ratio. It reflects the investor's expectation about the growth in the firm's earning. Higher PE ratio may reflect the higher growth potential. That's only we can say. Then the yield is coming. Earning per share should be converted into percentage. What would be the percentage, the value of this ordinary share? So when it is called yield, the denominator should be the value of the ordinary share would be in the market value. This is the actual yield. So it evaluates the shareholders' earnings in relation to the market value of per share. Earning yield, if the yield is very higher, it would be appreciated. Likewise, the dividend yield, market value is taken as a denominator and the dividend per share is a numerator. So percentage wise, it would be reflected. So the dividend yield is higher, it would be good. So for the fundamentals of corporate finance, this kind of financial analysis is limited. So you must do the advanced type of analysis in the third year. Third year means the commerce, accounting and finance students can learn these advanced aspects of this financial analysis in their subject of advanced corporate finance. So until that, you want to wait. And management students also, you can learn much about the thing in these financial management, the advanced cases. So I am going to upload one assignments. Assignment mean examples. One examples. So this kind of examples given with the answers, but I'll upload without answer. So that you want to get practices and compare that answer with your answer you obtain. So you can see the LMS now to do that. Some additional exercise also would be given to you. So third year, you have been asked to report physically from tomorrow. So we can decide whether you can continue by Zoom or direct class here after coming the next week. So I upload these exercises. You download it and bring with you to do the exercises. If you don't have any instruments with you, to view it. Now you can get it, I think, by leaving. Mm. Uh, the document example has been uploaded. You take down the and take a printout of it and keep it with you to come to the classroom and do the exercises. Or you do the exercises when the instruction is given. So it would be continued with the next session next week. Okay, now you can leave.